Welcome back to Simply Money. Tonight, we're going to be talking about, is the U.S. economy about to collapse? And I'm not using this as clickbait. I just really want to talk about this and get other people's opinion and kind of put some things at ease. I know there's a lot of turmoil out there right now. There's a lot of information going around, a lot of uncertainty. And for those of you that are investing, it can be scary times looking at things that we're seeing in the news, seeing the stock market. So, in this session today, in this live stream, I just want to talk through some things, kind of talk about some of the things we're seeing. At the end, I want to give some actionable steps that you can take to prepare for this type of thing. Maybe it's too late for this one, who knows? But it's going to come. We've talked about this recently, done some videos about how often corrections take place in the stock market. Basically 10 to 19% corrections happen pretty much on a yearly basis, and bear markets happen pretty much each decade, sometimes two a decade, sometimes maybe a little bit more than a decade. But it's pretty consistent that you're going to see 20% drops in a 10-year span. If you hold stocks for at least 10 years, there's a high probability that you'll see them drop 10 or 20% plus. And if you hold them for a year, there's a high probability you're going to see the stock market drop and correct anywhere from 10 to 19%. And so we want to talk through some of this, what to do, how to prepare, and kind of get our psychology right to make sure we're not panicking, make sure we don't become victims of hype, that we don't become victims of fear, and that we understand and kind of reiterate what our long-term goals are, what our vision, what our plan for investing is. So that's what we're going to dive into today. We're going to be talking about some of that. The U.S. national debt just hit $34 trillion. That in itself can scare people when you just hear that, like, oh my God, $34 trillion. And, there's talk with different things. And I don't want to make this political tonight. I want to make sure we keep things focused on what's actually happening, and then the possibility of what could happen, not pointing blame, not saying who's at fault or what's at fault, just the reality of what is happening and what could happen and how we can prepare for that. So let's try to make sure, if we leave comments, that we focus on those things and not make this a political focus tonight. So $34 trillion, there's talk that we could add another 4 trillion to that. So obviously the national debt is something that's been talked about constantly for years. I mean, I remember as a kid, and that was a long time ago, before we had the internet, before we saw everything in real time, talk about the national debt and how tragic it was. And I'm not minimizing that. Just know this isn't something new. We know, those of us that are older, this is the type of thing that has been around. But at some point, we have to make sure we get this under control. There has to come a time where we manage this, just like your own budget. Comes a time you can keep cranking up those credit card debts and get a HELOC on your house. You can keep expanding your debt, but at some point, the income isn't going to be enough to cover the output, the gross domestic product, the amount the country is making, our national income at some point is not going to cover our debts. And there's going to be an issue there, and we have to deal with it. And that means, just like in your real life, just like in your personal life, that we as a nation, we're going to have to make some sacrifices. We're going to have to make some real, look in the mirror decisions on how we can get this under control and what we're willing to give up. And, it may be us who have a little bit better financial grasp are willing to give up a little bit. So those who are struggling, I'm trying to keep this very non political. So we have to just know there has to be something that has to be done. I'm not here to tell you what that answer is. I'm not here to debate what the answer is, but something's going to have to give at some point. Um, Along with the $34 trillion national debt, we have inflation that, over 2022, 2023 was starting to get under control. It's come down quite a bit. It's seeming a little bit rocky right now. We're not sure what's happening, but that inflation has wiped out years of wage growth. As individuals and families' wages have increased, then you have a higher inflation like we had, that actually wipes out some of that growth that people had. So you feel like, oh, I'm getting ahead, I'm getting 3%, 4% raise at work, whatever maybe was happening with the economy and individuals, more income coming and going longer, but then all of a sudden inflation kicks up and now that money's not going as far once again. So it's almost like you've stepped back in your buying power. So if, let's just say, you get a 3% raise, but inflation was 8%, it's like your buying power, you just got a 5% pay cut. So inflation is a very difficult thing, and it adds to the individual struggles that people are having in our country. Add to that, the credit card debt has surpassed for the first time ever $1 trillion. So American consumerism and debt has passed, and this is just credit card debt. This isn't automobiles, this isn't home equity lines. This is strictly credit cards, your Visa, your MasterCard, your, Sears charge, whatever it is you have, those credit cards, $1 trillion. And that is becoming a burden similar to our nation individually, and for families that's becoming a burden. And part of that, I'm not saying all of it, some of it is choice, some of it is things we have done and we have to get that under control. But part of that is because of that inflation, because of that decreased buying power. People who were living paycheck to paycheck, now their paychecks not covering the entire month, and they're accumulating debt on necessities. Yes, there are people who are having to pay for food, having to pay for shelter with debt. And that is a tragedy that we have to find some way to help overcome. Now, a large majority of that, a bulk of that, is people wanting things now instead of later. And that is the consumerism that we talk about, needing to make that sacrifice and get that under control. But my question is, with all of these happening, with a $34 trillion national debt, with inflation gone up, back down, and now possibly creeping back up, with $1 trillion of credit card debt, are we on the verge of an economic collapse? Are we going to see a correction? Are we going to see a bear market? Are we going to see possibly a recession? For the last few years, we've been talking about, with inflation, are we going to get it under control, or are we going to have a recession? And we're going to get into that a little bit further in a few minutes here, about what a recession is, a soft landing, or even a bigger collapse than that. So over the last 3 days, this is simply the last 3 days. And again, I'm not talking about opinions. I'm not talking about causes of, blaming this person or this group. I'm simply sharing the reality of what's happening and asking us and looking, saying, what can we do to make a difference? What can we do for our individual selves and families to prepare for this type of thing? But just in the last 3 days, the Dow Jones is down 1,400 points, or about 2.9%. The S&P is down 250 points, which is about 3.6%. And the NASDAQ is down 900 points, which is about 4.1%. So in the grand scheme of things, when we talk about a correction that's 10 to 19% drop, we're not even at a correction yet. Obviously, at this rate, would be in one very quickly, but we might see, who knows, tomorrow maybe it'll go back up a little bit. Because what drives a lot of the stock market? Mostly speculation, mostly the news, mostly current events is what drives it. People's confidence in the economy is what drives the stock market. Yes, the value of the companies, the value that's going on, that is important, but a huge volatility factor in the stock market is consumer sentiment, is consumers and people buying or selling based on what's happening. Now you have your professionals, you have your day traders who are trying to time that and take, this market's going to drop, so I'm going to short sell all these different things. But a lot of people, a lot of the market volatility is everyday investors like you and I, who see these things, and we either throw a lot of money in because we see something climbing. And I know, was it 2022, everybody was talking about, get into Nvidia, buy Nvidia, this is the new stock, you got to get in, look what it's done over the last 5 years, it's going to go tenfold from here. There's always a stock like that you'll hear about. And so people are hearing that, they're excited, they're getting greedy. I want to get on the newest trend. And so it drives prices up. And you can have that with individual stocks or sectors or the entire market, because sentiment is, you know, fueling that confidence, like I'm going to throw my money in, it's going to work out. It works the other way. When things are fearful, people get scared and they start seeing dips like this, they start selling, they get panicked. Oh, okay, I'm going to lock in this 2.9% drop, or 3% drop. I'll lock it in. I'm not going to watch it drop 20%. I can't stomach that. I can't do it, whatever. And so the fear in that just accumulates and it keeps driving it down, because the news and everything, oh, it's dropping more. So you have the consumer sentiment and individuals feeling that, and that drives that a lot. But you also have just regular everyday news events. Now, I'm again not being political. I'm just saying, if you watch the other day, I think it was Monday or Tuesday, I apologize. My days run together here with all the news is coming so fast. But when the president talked about he is now implementing tariffs, if you watch the ticker symbol on the news while he was speaking about tariffs and what was going to happen, the stock market was just dropping and dropping. Why was that? Had the tariffs taken effect? No. Had it actually caused any economic impact yet? No. Whether you believe it's going to cause positive impact or negative impact, the point is, regardless of what it will do, it hadn't done anything at this point, but people's sentiment about it, people's confidence about it was this is going to be bad. And so the market started dropping. And that can happen if you hear about wars, about oil crisis, natural disasters. All sorts of things can drive consumer confidence to where it either pushes the market up or pulls it down. Now, there are things and factors that will actually cause the market to go up or down beyond just the sentiment. People still have to buy, people still have to invest or sell. That's what actually changes the market. But beyond just people's feelings, people's thought and foresight of what it's going to do, there are actually factors that impact it. And that's kind of where we have to be looking at what is going to be happening in the future. Is the US economy going to collapse? What do you think? In the chat there, throw your opinion. Do you think it's going to collapse? Do you think we're going to hit a correction? A correction is if the market from its recent high drops 10 to 19%. Do you think we're going to hit a bear market? And that's if from its recent high, the market drops 20% or more. Or do you think we're going to have a recession? Now, this will take time to tell, because a recession is 2 consecutive quarters of a negative GDP growth. So we would have to see 2 consecutive quarters of that. So to verify if something's a recession, it will take at least 2 quarters to see if that happens. What are your thoughts? Do you think we're going to have either of those, any of those, a recession, a correction, or a bear market? And if so, why do you think so? And what are you doing about it? What is your plan? Whether the market's going to correct, or we're going to hit a recession, or maybe it's going to rebound. Maybe this is the bottom. There's some people who are saying, today's the bottom, tomorrow it's going to go up. I'm going to buy today. So everywhere you look, people are feeling the strain, the higher prices, rising interest rates. This uncertainty is just infiltrated us everywhere. So that's where we're at. And that's the reality of it. And I'm here. The reason I started this channel is to try to encourage people who are looking to get out of debt, to learn how to budget, and to learn how to invest. And one of the biggest things I talk about to anybody I talk to about investing is, I'm a slow and steady investor. I'm not trying to hit the jackpot with this. I invest on a regular basis. I do dollar cost averaging. If I get a bonus, I put it in. If I get my weekly paychecks, I'm putting X amount of dollars in every paycheck. That's how I've been doing it, and I continue to do it. My paycheck tomorrow, I'll put money into the stock market, the same funds that I've been buying. I'm not looking, saying, oh, okay, this is the one I want, this is the next upcoming. I have a plan long term, and I'm sticking with it. So I continue to buy even though it's down. And the other day when it was at its peak, I put some money in it. So I've lost some money. If I looked at my portfolio on Monday morning before the stock market opened, and I looked at it today, I've taken a huge hit on paper. the amount that my portfolio showed, and I don't want to say I took a huge loss because I didn't sell anything. I did not lose a dime because I haven't sold anything. Um, so that's how I look at it. So I don't let fear, I don't let, the news, I don't let other people change my plan and my goals. And I think that's important to make sure that we keep that. Buzz, let's see, I think we'll be okay. Short term pain for long term gain. Think positive, but keep our eyes open. I agree. Like I don't know. Nobody knows the future. If we knew the future, would all be, sorry whether this offends people or not, would all be Elon Musk with our $400 billion. If we could see the future, if I knew for sure what was going to be up and what was going to be down in the stock market, it'd be easy. Nobody knows. And that's where we can't allow our nerves to change our goal, our game plan. Yes, you make adjustments throughout time, but it shouldn't be driven by emotion. It shouldn't be driven by news and speculation. It be any change you make to your goals, your financial goals should be well thought out and planned. And so don't allow this to change what you have set in your motion to plan for your future. Inflation's still high. And this is, again, I'm just sharing some information just to kind of process the impact it has. Even though, with the Feds hiking the rates and then they knocked it down a couple times, and right now they're not sure. Are we going to lower it? We're going to maybe raise it again. We're going to hold steady. But the bottom line is, over the last 2 years, Americans are spending about $700 more a month per household. And that's average. Obviously, you got high spenders who bring that up a little bit. But we could all agree that we're probably spending more than we were 2 years ago, especially if you're eating eggs. I used to, back in the day, I'd eat a dozen eggs every morning for breakfast. I'd eat like 3 yolks and the rest whites. I guarantee you I wouldn't be doing that today. I do not throw away the yolks. I would not dare do that. But we all know we're paying more for things. Even without all of this, on a regular basis, we see prices going up. I'm paying more than I was when I was in my 20s. Obviously, I'm making more than I was in my 20s. We just saw it accelerate a little faster than we're used to, especially our younger viewers that, you haven't seen inflation like we saw in the 70s or 80s. I hear it all the time. I try to encourage people. It's not easy. I'm not minimizing the impact it's having, but a 6 or 7% mortgage, it stinks, especially with the housing market as hot as it is, and it's been tough to buy houses. And then you add the interest rates. But back in the 80s, when you had 13, 14% interest rates on mortgages, people would have loved to get a 7% mortgage. So a lot of it is perspective. Again, I'm not minimizing the impact it's having. Um, we talked about the $1 trillion a year that we're paying right now just on interest. And I think that goes a lot to say there is some need when to understand the national debt, but I look at it, we have to look at our national debt and personalize it. We need to stop, in my opinion, we need to stop complaining about the government overspending when we're doing it as a household. If we're not keeping our budget in plan, we have no place. We need to start at home and then voice to our congressmen and senators that we really truly want a balanced budget and we want to pay down the debt. But we need to do it in a democratic way. We need to do it in a positive way. But debt is something that we in our nation have really taken on like, oh, it's needed. I'm not a big fan, and again, I don't mean to offend people. I just share my opinion. Robert Kiyosaki, I'm not a big fan of his because he talks about using debt like you can't be wealthy without debt. And I know you can use debt and it can be used in a powerful way. But I think, unfortunately, the way it's taught and the way it's pushed and marketed to almost take advantage of people wanting to, uh, just they sell whatever they're selling and not considering the damage it's doing to individuals. Debt is a very dangerous game to play. And that's why I push and teach all the time about becoming debt free and paying off your house if you can. Get that thing paid off, and the freedom, the emotional stability and freedom you get of being totally debt free. When you wake up knowing, hey, my house is mine. Yeah, my taxes may go up, my insurance may go up, but bottom line is I own this house. This is mine. And that's a great feeling. And it releases so much stress on how much income you need to provide for yourself. So we need to just understand that and understand how much consumerism has taken hold in our society. We know the housing market's hot, the stock market's volatile. Um, so I want to just share some couple things real quick. So basically, with inflation being high, there's three kind of, if I can say, options that will happen, and we still don't know how this is going to turn out. We'll wait, we'll see. You have a soft landing, and that basically means inflation continues to decline. The Fed will lower the rates at the right time, and the economy will kind of stabilize. And this is best case scenario, but it's not guaranteed. A soft landing is what we've been hearing for a little while. We don't know if that's what's going to happen. You could have a mild recession where job growth will slow, corporate profits will shrink, consumer spending will kind of shrink up a little bit and decline. And this is a little painful, but it's manageable. We'll see some unemployment increases possibly. And so a mild recession is like, let's just kind of get this thing readjusted. But it's not like devastating. It's not really hugely impactful. It impacts pockets more than it does um, overall nationally. And then we could have a severe economic crisis. And this is, debts continue to spiral out, banks struggle, unemployment rises, sharply. Those are like some of the indicators, and the economic downturn is really hard. And this becomes, really, really tough nationally. This really impacts pretty much everybody other than, those that are, we'll call them the wealthy, the ultra wealthy. Because I consider a lot of people wealthy that this would impact. You can be independent financially and be wealthy. People who may not have millions and millions of dollars can be wealthy because they have their needs met. They're financially free. When I talk about wealthy in this sense, I'm talking about those, have tens and hundreds of millions of dollars. A severe recession isn't going to impact them negatively. In fact, sometimes it benefits them positively because the market drops, in a bear market. Who was it? Here it is. Shelby Davis, a quote she has that I like, says, "You make most of your money in a bear market, you just don't realize it at the time." So as I'm buying on my dollar cost averaging during a bear market, as the market's dropping 2%, 10%, 15%, 25%, I keep buying. And then as it's climbing, back up, I'm still buying, and all that dip and rise, that is money that's really getting the best growth for me. And that's in a recession a lot of times what happens. People who have a lot of excessive income or cash, they're able to say, okay, this is dirt cheap, I'm buying. They're buying entire companies. You have people like Warren Buffett who will see a great company at a really good price, and he'll go and just throw billions of dollars into a stock and kind of get almost ownership of that company, or at least high ownership of it. And that's part of how they do that. But for us everyday people, us, trying to live day to day, those who are that are planning retirement, those who are already in retirement, and need to kind of guide ourselves through this. We need to be patient. We need to stick to our plan. Um, Warren Buffett, I'm going to give you one more quote, said that the stock market is a device for transferring money from the impatient to the patient. And that's what we talk about all the time. If you're investing in the stock market, you should be patient. This isn't a 1 year thing. You're not buying a stock. And again, I prefer ETFs, index funds. You're not buying that for a week, a year. You're in this for minimum 5 years. I don't put money in the stock market that I really don't plan on needing it for 10 years. It's being put out there for long-term growth. As you get closer to retirement, okay, yeah, I might need some of it, but I don't need all of that money. So it's a long term projection. And that's where wealth is accumulated in the stock market, is that transferring of money. Because right now, as we've seen in the last 3 days, the market dropping, people are selling. And guess what? Other people are buying. They're getting at a discount from what it was 3 days ago. If it continues to drop, people continue to buy and people continue to sell. Those who are selling are transferring money to the patient who are willing to buy and wait for it to come back. And if you look at the stock market, just take the Dow Jones or the S&P 500, the graph, and just look at it for 1 year, and those ups and downs look so sharp. Then stretch it out to 5 years and they don't look quite as sharp, but they're still there. If you stretch it out 10, 15, 20 years, what looked like a huge drop these last 3 days, do it and look at the last 3 days over a year. And these last 3 days look like a huge drop. And it is impactful, don't get me wrong, but stretch that out now and look at that chart over 10 years. And that drop doesn't look so significant. And it's way up here where it was way down here. And you see that difference when you get that bigger vision, and we're in this long term. So, what can we do, whether it's for this upcoming correction, recession, soft landing, whatever this is going to turn out to be, we don't know, or for the next one? Because I can tell you, I can't tell you what's going to happen now. I can't tell you when things are going to happen, but I can tell you with almost 100% certainty, we're going to have another recession at some point. I'm not sitting here saying, oh, this is going to be a recession today, this year. I'm not one of those guys that's going to get on the channel and do a video that it's going to be a crash, and then tomorrow I'll do a video that's going to be, a bull market, and then in 2 years I'll show that video again and say, "See, I was right." I am saying that we are going to have a bear market at some point. It's inevitable. It's happened throughout the history of the stock market. I am saying we're going to have corrections. It happens almost yearly throughout the history of the stock market. What is this current situation going to be? We don't know. So get your game plan and stick to it. Here's some things to do to prepare for this one or the upcoming one, however quickly it happens. Reduce your high interest debt. And when I say reduce, I mean reduce it and keep reducing it until it gets to zero. Um, I don't mean just take it down a little bit. Focus on your high interest debt and reduce it and stay focused on that. Get that out of there, especially if you have anything that's a flexible rate. Fixed rates still suck, but if you have a flexible rate, I know people who have flexible mortgages and the 5-year arm, and they got the arm when it was 3%. They think, oh, this is great. Look how low my payment is. And then at the end of the 5 years, it's adjusted to whatever the current rate is. Now they're paying 7 or 8 or 9%. It's come back down again, but that was impactful. Remember that in the 80s we talked about, imagine having a 4 or 5% interest rate, an arm, and then in 5 years you're paying your mortgage. You're like, oh, this is pretty good. I can handle this. I stretched myself a little bit, but I can handle this mortgage. And all of a sudden the interest goes up to 18%. You're dead in the water, foreclosure, sell your house, bankruptcy, all sorts of things can happen. Get rid of your high interest debt. Preparing for economic uncertainty, whether it's inevitably current right now, it's imminent, or it's a long ways down the road. Prepare, build an emergency fund. If you do not have 3 to 6 months of expenses accessible, not in the stock market, not in something that's going to cost you fees to get it out, simple cash in a high yield savings or a money market, somewhere where you can get it today if you need it, you should have at least 3 to 6 months. A lot of that, again, we talk on here, things are personal. If you're retired, you don't have any source of income, maybe you need 2 years worth or a year's worth. Everyone's going to be different. Again, do you have a pension? Do you have Social Security? Do you have other sources of income? Those things will depend how much you have based on those factors. If you have two incomes, maybe you only need 3 months. If you have one income and it's a commission type thing, maybe you need 6 to 12 months. But have a good, solid emergency fund based on your family, your individual circumstances, to be prepared, because we never know. The job layoff could be you. The unemployment, and I don't mean to be doom and gloom, it could be you, and that would be sad. But things that are tragic can become inconveniences when we're prepared for them. Emergencies, when we have cash on hand, when we've been preparing, we save up cash. And I talked about this on a recent video. I had my hot water heater went, and then something else, I forget what it was, when, and it was several $1,000s. I'm not rolling in money just like, "Oh, here you go, no problem." But it wasn't a devastation. I didn't have to get my credit card out. I didn't have to go in debt and pay on that because I've planned for household items. I've planned for unexpected things and I have money set aside. So emergencies become inconveniences. And so that's why the emergency fund's so important. And when economic times are uncertain, it's even more important to have that cash availability. Third thing you wanna do is you wanna make sure you're diversified your income, your investments, and diversify them. And I don't mean just like, okay, I have cash, I have bonds, I have, CDs. You wanna make sure if you're invested that you're diversified, different sectors. You don't wanna be all in tech. You don't wanna be all in, consumer goods. You wanna have it spread out in different sectors. And then beyond the stock market, you wanna have some cash. You wanna have some, I like dividend paying funds. You want to have some stable, like blue chip companies or ETFs that are providing a source of income. For me and my portfolio, because I'm not living on that income, it's just to stabilize. For me, the ETFs that are high dividend focused kind of counterbalance my uh, high growth funds. And so they're not as volatile. But diversify if you're able to get into real estate and other opportunities to hedge your investments. That's really important. Um, Number four is cut your unnecessary expenses. This is something we should be looking at. Cutting our unnecessary expenses. We shouldn't wait until there's a tragedy. We shouldn't wait until we're unemployed. We shouldn't wait until there's an economic hardship. We shouldn't wait until the economy crashes. We should plan and live in a way that we're cutting unnecessary things. Look at ways to make small changes to get yourself in a better place. Now, I'm not talking about not enjoying life, but if you have high interest debt, if you don't have an emergency fund, if you haven't been able to begin to start saving, if you're not taking care of some of these fundamental things, we should be looking ways to cut on unnecessary expenses to increase paying off debt, to increase our emergency fund, to increase our ability to invest so we can be in a better place when we're older and ready to be financially free and independent from a job. If you want to keep working until you're 100, fine. I'm all for it. If that gives you motivation, keeps you going, I'm not opposed to that. But you should have the opportunity to not have to do that and prepare yourself for that. And cutting non-essentials is important. Um, and everyone has different things. I'm not telling you to do this. I share my experiences as examples, not, hey, you should do this. But I remember for years, we didn't have cable as a family. One, it was an expense we didn't want to, spend. We didn't want our kids having tons of screen time. We wanted to spend more time as a family, board games and sports and activities. So that was an expense we went without. And, we didn't have that for years and years. And there's lots of things. For some people, you'll hear people say, make your coffee at home. Don't drink Starbucks. I don't drink coffee, so it doesn't bother me either way. But I can understand that. I remember my dad. He retired when he was 55. My mom was 52. Um, he had quit smoking years before, and he talked about if he hadn't quit smoking, he probably wouldn't have been able to retire that early because that expense that he was a three pack a day guy. It was bad, but that expense and how expensive it was getting at the time for those years, that was extra money he was able to stash back into his retirement, into his savings, and that helped. So little things can make a big difference. Again, I'm not saying don't enjoy life at all, but find ways to cut insignificant things that are not necessary. And number five is look for ways to increase your income and job security. That may not be possible for some people. There may be jobs that your job is what it is, but there are ways you can increase your skill set in case something happens while you have a job. Look at ways of increasing your skill set. Learn a new skill, learn something, get a new certification, learn something new, find a side hustle perhaps. But a lot of times we wait until we're unemployed and say, oh, I'm going to retrain in this. Start getting training in something else. And if you're in a job that you don't really like, start looking at ways to increase your skill set while you have a job to help prepare in case something does happen. And the last thing, number 6, stay informed and avoid fear based decisions. Kind of what we started on. Don't let the news, don't let your emotions, don't let the psychology of things hinder you from your goal. And do not panic sell. Avoid panic selling at all costs. You're going to see the market fluctuate. I've seen it in my short lifetime of investing. I've seen my portfolio drop 28%. That's a huge hit. When you're first starting out, and let's just say you have $10,000 and you take a 28% hit, now you're down to what, $7,200. That hurts. You're looking ahead 10,000, and now I only have 72. Well, now let's say you're at 100,000. Well, now you're down to what's that? 72,000. That's a big chunk. You're sitting there going, whoa, I just lost 28 grand. Well, let's say we're at a million. For those of you that have achieved that, congratulations, by the way. Now you're down to 720,000. See, that 28% looks a lot different and feels a lot different the further along you are. So you can't allow that fear base to change, because it works the other way too. If I have $10,000 and the market goes up 10%, now I have 11,000. If I have 100,000, now I have 110,000. If I have a million, now I have a 1.1 million. See, instead of gaining 1,000 or 10,000, now I've gained 100,000. So I get that bigger reward, but I also have the bigger loss on a down market. And that's that emotion that causes panic selling. So here's the bottom line. There's real challenges ahead of us. We don't know. Stay the course, be faithful, know your goals, have a plan, stick to it, and take some of those actionable steps to pay off your credit cards, your debt, get an emergency fund, do those things that we talked about, and begin to be prepared, because whether or not it happens now, these things will happen. I guarantee you, we will have a recession again at some point. We will have a bear market again at some point. We will have corrections constantly throughout your investing life. That's inevitable. But be consistent with your investment, with your plan, and don't panic sell. Be patient and stick with it. That's all for today on Simply Money. I appreciate you joining me, and we'll see you next time.